Hey guys, Mike here. So another jam-packed video for you, and I would say it was an interesting day, but it was kind of like almost like yesterday, right? We stayed in like this 0.5% range for the SPY, stayed red all day. Qs being held up, by what? Some of the big mega cap stocks, which we'll, kind of talk about in a little bit because there is something going on. All right, I was just talking to members about that, and it's something to pay attention to because it's happened before, like 3 different times in the last year. But the setup was there. This morning. I don't know about you guys, but we were sitting there looking at like, hey, look at PPI, right? Year over year, and even the core, right, coming down. I mean, looked good, all right. Now, what's that mean? It means the Fed, they love to look at this stuff. That means this should be leading CPI down. So, hey, they're going to have to cut. They're going to have to cut this year, right? I mean, that's what's going to happen, right? Because inflation is going to fall off a cliff, right? So we saw that, and I was like, oh, great, man. Then, hey, initial jobless claims, more people, unemployed. That's what the market wants to see. This is wonderful. Setting up for great, rally here. Let's go, go, go. Because this means, great, the market's slowing down. So there's definitely no reason to do any more rate cuts. Definitely going to get our pause. Definitely going to get our cuts, right? And I mean, the bulls are absolutely salivating. I thought for sure starting at the open and we were going to go and take off. But of course, that wasn't the case. I think one reason for this, and I put this in the Discord pretty early on at 9:09, we were talking about this, is because Jamie Dimon comes out and makes comments like, commercial real estate is going to bring down some more banks, and then you have PacWest come out and they slumped another 20% pre-market because they come out and said they lost 9.5% in deposits in the first week of May. So it continued for them. And then you had something that's gaining a little traction, a report that was put out and starting to get some headlines was not just the deposits from the regional banks, it's the deposits from the big boys like Bank of America and Wells Fargo and stuff. And if you can look at this chart right here, you can see they lost quite a bit. I mean, and it's been downtrending since July of last year, from 11.18 million to 10.53. I'm sorry, million. Trillions. Excuse me, trillions. But when you compare that to the chart we scroll down here of the regionals, they were fine going through that same time period. They just got the scare that just started happening in February, right? So actually, the bigger banks has been losing deposits this whole time, but just nobody talks about it, right? So where'd the money go? Obviously, I think it probably went into treasuries and other things. And so I think that might have spooked market some. And of course, the regionals look bad again. The regular banks look bad again and was a drag on the S&P. Now, the other thing that's happening, and nobody's talking about this, it seems like, but the credit risk, like for the U.S. here, is looking like emerging markets, as it says right here. This is the U.S. CDS spreads, credit default swaps, that are higher than what you see in actually countries that have defaulted, right? So this is comparing us to Mexico and Greece and Brazil. And this is if you wanted to insure your 1-year T-bill, okay, and what it would cost. And look at that. That's us at the top. Look at where the other ones are at. I mean, that's crazy. But this is what Congress has done, right? This didn't start until everybody's like, oh my, are we actually going to default here? And guess what they just did? It came out a few minutes ago. They're going to delay discussions until next week. So now we get more delay, right? More uncertainty, which is something else is hanging on this market because it's been through this before and there's hardly any trust in the politicians, even though we know, that are they going to do it eventually? They should. Why they lead up to the last minute? Again, I don't know why they do this, guys. You can let me know in the comments if you do. And if you're liking this video, guys, please hit that like and subscribe button. That will be the thumbs up right below the video there. Just go ahead and hit that for me. I sure do appreciate it and all your support. And if you like this kind of content, think about subscribing. And just to let you know, so you can have actually reached out to me, and this sale will end on the 22nd. So I guess that's 11 days from now. So if you want to get it for $99, you can do that for another 10 days. Again, you get pretty much everything you want on their site. You can look at the top stocks, top ETFs, stock screeners, the ETF screeners, comparison, analysts, news, you name it, you get it on there. If you want to take advantage of that for the next 10 days, just go right below the video and you can click on that link right there and sign up if you are interested. All right. Thanks, guys. And again, let's keep things in perspective here, guys. Here we are once again, this range, 3,900 to 4,200. It's a 7% range. Been stuck in this for the majority of the time. We go outside the band and down below the band a few times, but all the way since last June. Okay, so if we get to June again, we're still in it. It'll be actually, I'm sorry, it's May now, so it's going to be a whole year. We've been in this range. That is a kangaroo market. Okay, this is not a bull market, bear market. It is a kangaroo market right now. Okay. And so I think we can all agree on that. Maybe we're going into a bull market. Maybe it'll be the first time in history we've done it during this credit cycle, which I'll touch on in a minute. But, you know, again, it's a 7% range. And do I think we're going to go to 4,300? I think we're definitely going to go to 4,300 before we go to 3,900. Would be my guess on this. And I only say that because if they get the debt ceiling passed, which they probably will, it'll be a lot of shenanigans and all that stuff. You know, good to go. We've gotten through earnings, and you know, hey, it's shocking. Wasn't no earnings apocalypse. Said it 6 months ago. What's going to happen? Fourth quarter. Oh, not so bad, not great, but not bad. Oh, first quarter. Nope, didn't happen. All right, and you still got these big tech stocks just ramping up. Semiconductors still going crazy, right? And so that's what I'm saying. And you got the, also don't forget the pause. When the Fed actually officially pauses, especially if they say it, markets usually go up. Markets go up before that, actually. Excuse me. So I've showed that many times. And you can go look at the chart yourself. Just pull up the Fed funds rate, pull up the Q's S&P over it, and you'll see exactly what I'm talking about, okay? And so could this time be different? Of course. This is a very strange year. But understand what I say about bottoming in this credit cycle or going into a bull market in this credit cycle. Normally, when you're going into a raging bull market, rates are zero, money's cheap, it's free, everybody's leveraging like crazy, and here we go, right? And the big money's buying up cheap old stocks that have been beat down, and away we go. Well, obviously, this credit cycle, we're in a tightening cycle, higher rates, and on top of that, higher inflation than we've had since the 70s. And so, you know, that is a lot different environment, right? So I say it'll be the first time, at least in my lifetime, but maybe if you're, I don't know, 90 or something, you've seen this before. I never have. So what has to happen if you want to see, you know, this rally continue is watch IWM, right? I heard some bulls talking about this, and they look pretty worried. They said, look, if that 170 area breaks, we got some concern going on here, right? Because we know small caps hadn't been participating, especially micro caps. Definitely watch them. That is a big, big component to this whole thing. Also, that ratio IWM versus the SPY, right? Right now, IWM is not performing very well compared to the SPY. That needs to change, and this is a key technical level right here. If we get the bounce, same thing on the chart of the IWM. This has been a kind of a technical type of market, so good chance we get the bounce. We'll have to see if it falls through. As you can see in the past, when that happens, it's not a good thing, right? And so these small caps and micro caps especially have to start showing strength, okay? And then, of course, Tesla. Tesla, I don't know if you want to call that a bear flag or whatever, but it's going up in this gap. And you can see it had, oh my goodness, at 345. Look at these candles. Look at the buying volume coming in at 345. And you go, what in the world? Did something just happen? They just raised prices again? It must be something super heavy going on with Tesla. It had nothing to do with Tesla. Musk announced that he found a CEO for Twitter. It's going to start, I believe, in 6 months. So, of course, people are like, yay, he's going to be able to concentrate more. And I found this meme today. I just loved it. It said, Warren, just say Tesla stock price is too high. And Elon's like, okay, it's too high. Yeah, but anyway, found that meme and got a good laugh out of it. But yeah, so I guess people are like, hey, in 6 months, who knows who the CEO is going to be? Who cares? But he'll be able to concentrate more on Tesla and stay away from building rockets and fighting on Twitter and stuff. So may see a jump in Tesla tomorrow. We'll have to see if it carries over. Now, Chinese stocks. You're thinking, oh, man, this is great. Look at all the Chinese stocks up today. What happened? Well, as I put in the morning news brief right here, you can see this. It's a whole different world when you actually own your banks. And I mean the government owning the largest banks, right? So China's consumer prices barely grew in April while borrowing slumped, providing further evidence that the economy's recovery is waning and fueling expectations of more central bank stimulus. So, of course, what they end up doing is they'll tell you what, we need to stimulate this puppy. So the country's biggest state-owned banks were permitted, or basically ordered, to lower the rates on so-called agreement and call deposits. So what this is going to do now is going to drive down their cost, giving them scope to lower loan rates and helping to fuel lending in the economy, which is the opposite of what we got going on, right? We got banks tightening lending and afraid to lend out and afraid to have a bank run put on them and everything else. So, you know, that's what you're seeing going on there. So don't be surprised if you still see Chinese stocks running or whatever. You keep seeing them going up and then selling way off. And so, of course, I guess China's going to start stimulating their economy. So just keep an eye on that. Now, Disney, which I never even talk about, but boy, they got hit hard again after earnings, about 10% down. And, you know, they're really at a key level. It's not an accident of why they stopped right there, like $92. And it's because this one goes pretty far back. I mean, you can see how well it respected, right? About 2000, what was that, 14? And if it drops below that one, boy, it ran up so fast from 2012 to 2015 that, it's going to be a rough one for Disney. So we'll see what happens there, but just keep a close eye, especially if you're in Disney and stuff. And that was the weekly. I'll go to the daily here and kind of scroll over and everything, and you can get a better look at it because there just ain't a whole lot of support below that level. And that's going to be an interesting to watch. Since the only time I've really been below it in all these years is 2020's crash. Now, something else to pay attention to here, guys, is consumer staples versus the equal weighted S&P, right? And you can see what's happening now. Or, for example, you don't want this actually outdoing the equal weighted S&P. You saw it was outdoing it right there in 2022. What was happening? The market was crashing. All of a sudden, the equal weighted S&P started outdoing it. What happened? The market rallied. What's happening now? Consumer staples are actually outpacing the equal weighted S&P. And so again, what do you see there? From 2020 on down, the equal weighted S&P was outdoing it, and the market was rallying like crazy. So you don't want to see this. So this is another ratio we got to watch and see if it finally turns over, right, to help fuel the rally and stuff. And tomorrow, make sure you pay attention to see if we end up in the old valley 3 weeks in a row. Obviously, we have weekly options expiration. You can see a lot of puts around 410 right there. You look at the call, you're talking about 416, 420, somewhere in that area. So, they can stick us between 410 and 416, grind us all day long pretty much, keep us in that valley where market makers win. Or is the valley going to be between 410 and 420? That's really, what we got to figure out here. So, again, I don't see them just voluntarily paying out a lot of options. So keep that in mind. And the only kind of data we got coming out tomorrow to pay attention to is consumer sentiment. I told you it's absolutely in the toilet. And when it's usually that low, that's usually a contrarian indicator as well, kind of like the fear and greed index. So just keep that in mind as we roll into tomorrow. And it is Friday. So, I'll be here doing another video for you, and I'll recap what happened and stuff. Put down in the comments, what do you think is going to happen tomorrow? Do you think we're actually going to break 416 or more likely to break 410 to actually head south? So, and do you think Tesla's going to gap up in the morning, which I think a lot of people are calling for, just because it obviously, the Tesla followers who like to buy in absolutely love that news that they finally found a CEO, even though, remember, it's 6 months from now. Long way off. I think that maybe they saw the headline, it popped, and they went, wait a minute, 6 months? That's a long way off, man. Good Lord, we're supposed to be in a recession by then, right? So anyway, again, I'll keep you updated on all those ratios. When I show them to you, don't mean you got to, track them or anything. It's just kind of like going, hey, this is just certain things. Big money's looking at this too. We got to be looking at it. So I'll obviously keep you updated on it. So if you got something out of this, hit that like and subscribe button. I really appreciate it. If you want to take advantage of that Seeking Alpha deal for the next 10 days, down in the description right there, you can cancel after 7 days if you don't like it, okay? So have a good night, and I'll see you tomorrow.